Happy Monday, y'all. Kevin coming to you once again with Weeds Weekly Wrap. We cover this past week, this up and coming week, some random thoughts, and this week we're going to cover now what. So let's just dive right in. This past week, we had anticipated some explosives, right? I talked about the 7 days of trading that were coming up. We are on day 6 right now, but unfortunately for us, last week didn't really paint the picture that we were hoping for. We were hoping to start to see that jobs were getting under control, and Friday's jobs report was anything but that. However, we did have the revisions that saved the day, but let's first just talk about the raw number. The number once again beat forecasts. We came in at over 270,000 new jobs created. I believe the market was anticipating around 200,000, 210. So that number just on its face would push treasuries on the increase. It would push interest rates up. However, because of the large revisions that we had to the previous month's number, we were saved. That really saved the day, along with the past couple weeks where we have been riding along at an extremely slow pace, although with positive economic data, but the slow pace has really been there, right? We're not really seeing anything significant other than slow trickle downs. The revisions saved us. They were over 100%, 100,000 jobs less created. So they had said that we had 353 jobs created the previous month, and they revised that all the way down to like 228,000. That is significant. And what that kind of did for the market is it solidified that we rode into the weekend in the high 6s. We got out of the low 7% average interest rate on the 30-year fix, and we moved into the low 6s. And really what it did from the trading perspective is it emphasized that possibly things are changing on the job front, that possibly the 275 read that we just saw that this past Friday is going to be revised lower. So now all eyes turned to this coming week. And as we've talked about before, I talked about the 7 days. Tomorrow's day 7. Tomorrow morning, we're going to get CPI numbers. CPI numbers are highly inflationary. They will give us the idea of what is going on with prices and services, of goods and services. And that is going to be a big indicator. Now, last time, we saw a very slight increase in that number. Almost came in at forecast, beat it by a little bit, and it didn't really move the market a ton. But because of that explosive jobs report, we moved up into the 7% range. However, what I can say is the CPA is going to have the final say. I've been talking about it for quite some time, that the beginning of March was going to dictate our spring and summer selling season, and here it is, right? So we saw this past week, not a big needle mover. We got below the 7% mark. So what we're doing is we're crossing our fingers and our toes this time, in hoping that at the very least that CPI comes in right at forecast. If it comes in higher again, that's not going to be so good. Even slightly higher, as we saw last month's report, that is not going to be good for interest rates. We need that number to come in at forecast, if not below. And if below, we can expect some explosive moves in the treasury market and in interest rates. If we come in at forecast, I think we're going to experience a lot of the same. The other thing that we have this week, once again, that I think is a good indicator of where things are headed, and it doesn't get talked about enough, is the consumer is up. Retail sales. The consumer drives the economy. There's no mistake about it. We saw that through the holiday season that we talked about last year. The consumer can't stop spending. What we have seen now since the beginning of this year is affordability is a concern, and the consumer is retreating a little bit. They're not spending as much, and so on and so forth. We have now read most recently in some of the reports in the media that, hey, big ticket items are on the move again. They're seeing an increase in clothing and things of that. But we're also coming into seasonal changes, right? So, the clothing thing I get, the big ticket items we'll see, but the consumer spending and the retail sales number I think is going to be significant, because it's going to really tell us that if that consumer is pulling back, then inflation is going to follow. The price of goods and services are going to have to come down because the consumer is just not spending as much. All right, so now let's get on to the thoughts. And I think this is critical. Love them or hate them. And more often than not, I am against them. But let's talk about the fact that we need them, and it's the media. And let me just kind of bring this all together. we need the media and the fact that we need them to be pumping out that interest rates are going to be lower, that interest rates are in the mid sixes, that interest rates are on the decline, that inflation is getting tamed, that the CPI number came in better than expected, and that is driving interest rates lower, right? Perception again is reality. We need the media on our side. So love them or hate them, we're fingers crossed that that CPI number is going to come in favorable to us, that it's going to trigger all of the media outlets, whether it's podcasts, whether it's, online, whether it's on the TV, however the consumer is digesting that information, all over the place. It's going to be talking about a potentially hot spring selling season, a great real estate market, lower interest rates, more people coming into the market, both buyers and sellers. We need that presence because as we can see, just us doing the legwork of pushing the good narrative that, hey, now is a great time to buy, interest rates aren't so bad. Things are just a little bit sluggish because we're hovering around that 7% range. We need the media to come in, to be our advertisers for us, to be the people that are actually spending the ad dollars on our behalf to push people into our marketplace. So, hey, love them or hate them, we need them and we need them now. The last thing I wanted to cover is now what? So let's assume that tomorrow we get, we were expecting all these fireworks, the 7 days are up, and no fireworks happen. We had the jobs report. We had a CPI number comes in basically right around forecast, maybe slightly above. Now what? Because by this time, let's all be honest, at the end of last year, we were all told and we were expecting that interest rates were going to be lower. As a matter of fact, I just saw an article today that Fannie Mae, who said that we'd probably be around, I think it was the mid 5% range, has now said, now we don't believe that. While we believe that activity is going to be up, we're moving what our expectation of the interest rate will be higher. So it didn't take them long. What's that? Let me look at my watch. 2.5 months for them to change their tune, so to speak, or I think I saw that article a month and a half ago. So again, now what? What do we expect should that number come in slightly above forecast, which it did last time? I think what we can expect is exactly what we are seeing now. I think we're going to see slightly increased activity, just natural progression based on the seasonality change, right? Spring is typically a time where, hey, winter's behind us, people get excited, the sun is shining, people's spirits are brighter. However, that affordability term is weighing on people. At the grocery store, they're still feeling that pinch. The dry cleaner, who used to be, $1.99, $2.99 a garment, is now $4.99, $5.25 a garment. I mean, people are feeling the pinch, and it's only going to continue to keep pressing them into a corner. So the now what is, if that happens and we see CPI come in just slightly over forecast, we are going to expect a lot of what we're seeing right now. We are going to spend the spring in the beginning of Q2, a good part of our summer, in the high 6s to low 7s on interest rates. We are not going to get much reprieve off of that number. As the Fed has said several times, and they say it all the time, and we'll repeat it, they have clearly stated that they need consecutive months of data that is favorable to them for them to consider reducing interest rates, which falls right in line with our July estimation of when they'll begin to cut. If that number comes in tomorrow and it's, again, slightly higher than forecast, what we can expect is now we have to push off into April. We get an April read, we get a May read that are possibly beneficial, but I think once again, we're still gonna see mixed signals. We may get inflation that's not so sticky, which it just is right now. Inflation seems to be just really sticky, and I think a lot of it is that job creation. You have a lot of companies still sitting on all their profits, not decreasing the price of their goods or services, and they are remaining very profitable, and that is flowing into the jobs market, what is creating more spending, right? And it's keeping these numbers high. So inflation is just remaining very sticky at the present time. So that pushes us into mixed signals come April. We maybe get on the right track come May, June. That first cut comes in July. And then we're right into basically the election, right? We're right in the dead of summer. We're right facing election with August, September, October staring us in the face. We know that our consumers are going to be in quicksand. So look, hey, fingers and toes are crossed tomorrow that CPI comes in at forecast or slightly lower. If that's the case, what I anticipate is we could, I don't want to say quickly, but I will say that I think that the ceiling for the Treasury gets below the 4% mark. And I think we start getting into the sixes. We start looking at maybe mid sixes to high sixes, depending on credit score for the average 30-year fix. We get out of the sevens. The sevens are no longer a talk of the town. I think that will lighten people's spirits a little bit, or bring them up, I should say. And therefore, I think we're going to see a little bit more activity, but we're going to be hovering in that space. And in next week and the following weeks, we'll talk about what our strategy should be based on our CPI number tomorrow, because right now we're kind of in flux, right? Do we want to go to market and start screaming from the rooftops that, hey, rates are in the mid sixes, let's go? Do we want to still be talking about appreciation come 2025 and 2026? What is our marketing strategy? Does the CPI number come in, as we've already discussed, favorable to us, and the media is doing our marketing for us? We just have to put our smiling face out there and show a bunch of houses and say, hey, now is a great time to buy, and the sun is shining and the weather is warm, right? So a lot of that is going to hinge on tomorrow. We'll dive more into that next week on strategy and what we should do and what it means and what April looks like and what May looks like and what June looks like and so on and so forth. As always, hey, you need anything, please don't hesitate to give a call. It's always good to reach out, get a real-time connection of what the market's doing, what interest rates are, and what you should be doing as far as how you should be talking to your clients to get more business, to move those clients off the fence, or to talk down some clients that are just nervous with their current listing or a deal that they have under contract. All right, everybody, have a great week. Happy selling, and I'll talk to you next week. Cheers.